Hello and welcome to a wonderful Thursday on Crypt. Oh my god, the markets are tanking. Now, why is that happening? What does it mean in relation to gold? And some other interesting drama that we're getting into. Suffice it to say, day by day, the world is uncovering the value of blockchain, and I've got some great points to look into on that. Let's dive right in. Bang. Now, first and foremost, we have this extended conversation around centralized exchanges versus DEXs. Obviously, Hyperliquid has been core to this conversation, with it being a DEX that has been growing tremendously. Hyperliquid just has a lot of traders using it. And of course, this idea of permissionlessness is so core to the ethos of crypto that to look at these exchanges, take trading fees that capitalize off perpetual liquidations. I mean, there's a certain point where they have so much power that you're like, are you actually benefiting the industry? And this all came to a head on Monday when CJ Tech, who is the CEO of Try Limitless. Limitless is an hour-by-hour betting platform on a variety of topics, but he comes out and just kind of lifts the curtain on the Binance listing process. Now, what's fun about this is somebody obviously forgot to make him sign an NDA, and he basically got this offer, thought it was ridiculous, and turned around and announced it to the world, which is honestly about freaking time. And we can see why, because CJ comes out and he says, look at this offer from Binance. 1% airdrop on day one, 3% further airdrops on 6 months, 1% for marketing at Binance full discretion. That's 4% of your total token reserves that you raised all this money and put all this effort into. Provide 100% of the TVL for token pool on PancakeSwap, $1 million plus. So PancakeSwap is their DEX. And the TVL means more of your tokens have to go in. $150,000 security deposit. 3% reserved for BNB holder program. Let's keep in mind, 80 to 90% of the BNB supply is held by CZ himself. So holy moly. $1,000 worth of token at most favored nation price for Binance affiliate marketers. MFN is a clause written into private investors. So this MFN price could be like the seed round. And just say 200,000 worth could really be worth like $1 million if you 5x cents in. $2 million BNB security deposit for Spotless. I mean, guys, we're looking at close to like 6% of your total token supply and millions of dollars. This is where we're fucking up as an industry. These companies are raising so much money on the private rounds. They're going, 10 million val, up to 100 million val, up to $1 billion valuations. And that's why when we see them launch, they just continually go down and to the right. And let's be real about the setup that this provides. All of these airdrops, this 1% and then this 3% at the top, that is going to users who receive this asset for free. Now, why would they be married to this asset? What is the point of them holding it, right? We're looking at about 4% guaranteed sell-side pressure. So the second you see this guaranteed sell-side pressure, let's move over to the TVL of the token pool. You're providing 100% of your token side plus the stablecoin side. Now, everybody sees selling pressure going on, so they're going to sell even more. So this means that your TVL that you're providing is more tokens going and being sold and making a downward pressure on this. Of course, the BNB holder program is like, that's mostly CZ himself. And when we look at 1% for marketing, are they just going to simply sell that 1% in order to use marketing dollars? Like, we don't know how this works. So you can see the sell side pressure that Binance builds and requests from any team that wants to list there. Now, conversely, you can go to Hyperliquid. You can participate in an auction to get your ticker. If you're building on Base, you can list on Aerodrome, and that guarantee pushes you to Base app, and that will expand into Coinbase itself. If you're just on any other DEX, like let's say Jupiter or Meteora or whatever on Solana, I mean, you can take your capital, your coins, and your money, and you can provide both sides of that pool. So there's just so much utility that you could be doing with your cash versus what is looking like chopping off an entire limb at the altar of Binance. And this caused quite a stir. Of course, you have an ex-Binance person coming out here calling him immature, saying, no principles, you signed an NDA. No NDA was signed. And I guarantee somebody's getting fired for this. Now, what was really interesting was that Binance did hop into this whole thing and had an entire conversation around this. And he says, look, on listing fees, saw this a few times recently. Anyway, they get in here and they dig themselves even deeper. There was an entire thread specifically on CJ and this post. And you know what happened? Was Victor Bunin, one of the protocol specialists at Coinbase, writes, and I did catch this in real time, do you really want courts looking at your listing process and your communications? And of course, that is now deleted because they did go into depth and it looked like, hey, this is very pay to play and it's not egalitarian and this is against the ethos of all of crypto. So this only makes 2 points very concrete in my mind. One, we need to get back to the crypto ethos of permissionless finance. That means decentralized exchanges where you don't need permission to list. exist. I do believe that these high and egregious listing prices are what forced a lot of projects to raise more private money. It used to be back in the day that you would buy something at an ICO for like a $10 million valuation, and then it would go up and you'd be able to ride that value accrual. Now, that value accrual is happening in the private rounds with early stage investors, with a lot of that value being given away to things like Binance, for example. And of course, with this much built-in sell-side pressure and overvalued companies, it's no wonder why the dumps keep happening. So you could save all of this money, you could raise a lot less, you could launch at a much lower valuation, and you could provide liquidity to your DEX pair or get on Hyperliquid, which has a ton of opportunity to go long and short, and ideally allow people to ride up a much lower priced asset into something more mature and solid. Because of course, we know that the technology continues to build out and establish itself over time. So this has led to a cascade over the week of anti-Binance sentiment, with a lot of experienced people like myself coming out and saying, yes, we hate this. We don't believe this is the way that it should work. We should be talking about it more, and hallelujah to CJ. Now, on to a sort of intermediary point as I go through different stories. Just in, Florida files strategic Bitcoin reserve bill. House Bill 183 will allow Florida to invest 10% of public funds in Bitcoin. We've seen Bitcoin perform quite poorly today. It went down below 108,000. It had a little bounce, but we're seeing at the same time gold just exploding up and to the right. And as I talked about previously, this might be just a momentum play. People see gold going crazy, they want to hop on board. But we're also seeing lines form outside of bullion sellers across the world. And why is Bitcoin falling behind? Well, the world is in a state of uncertainty. There's authoritarian regimes picking up pace. A lot of the normalcy seems to be thrown out the window. We have conflicts everywhere, and this is generally a gold safe haven moment. However, Bitcoin is around, and one of the main issues that we've seen regarding its price, which I have spoken to in the past, is that there's a lot of OGs, people who mined Bitcoin, people who bought it when it was sub $1, just a few cents. And like we saw with the $9 billion Bitcoin whale sale, we just have a lot of OGs dumping their supply, saying, hey, look, I rode this thing from like under a quarter to $100,000. I am out. I am safe. So that being said, we still have this amazing buy-side demand. We have El Salvador and Bhutan showing that nation states can actually bolster their treasury by adding Bitcoin. We have companies adding it to their treasury. We have states beginning to look at it as a value of accrual. Bitcoin is still crossing the Rubicon that gold has obviously held for such a long time, but the reality is that the institutions are finding better demand for it, are awakening to the power of blockchain and permissionless finance, and continue to build more and more on top of that. Now, as we continue everything post-Genius Bill and stablecoin boom, we also see that SEC Commissioner Peirce makes case for financial privacy, says tokenization is a huge focus now. And tokenization is something that you're probably hearing a lot about on CNBC, and people don't really know what it is. But as we look at digitizing the traditional finance world, where it can only trade between business hours and it requires banks and intermediaries and all these different humans with jobs to facilitate just honestly moving an asset from you to me, we now have blockchain that runs all day, every day. It has no downtime. It doesn't require all these middlemen, so it does things for cheap. And the fees and the speed and the consistency are just game-winning products. There's no way around that. And what really excites me as we do build out a lot of things like USDAI, like Daylight, which are really private equity plays wrapped in blockchain. They revolve around a specific asset and they unlock liquidity. Blockchain wants to take stagnant money and make it move. That is what its core goal is. Mo Sheikh, the ex-CEO of Aptos, comes out with something I firmly agree with, which says, look, run back the Meridio days, but this time with the entire stack. Make capital structure composable, transparent, and tradable in real time. If you think about it, debt is already partially unbundled, especially in public markets. You're essentially buying different layers of the capital stack, each with its own risk and reward profile. Senior debt, preferred equity, common equity. Each layer has its own economics, risk exposure, and governance rights. Managing that complexity today is a headache of fragmented contracts, covenants, and intermediaries. Tokenizing would change everything, to which I very much agree. And I've been making this point recently that blockchain will be for businesses what the Aura Ring is for your body. And when we begin to tokenize every element of a business, whether it be their cash flow, whether it be their treasury, whether it be their debts, we will be able to have this living pulse that we can see through a dashboard dashboard, just like we do with Aura Rings, with Apple iWatches, whatever you choose to collect your biometrics. But we'll be able to see a business in real time as money moves in, as money moves out, as expenses happen. And we'll be able to fractionalize those components and say, hey, look, we have a lot of latent capital sitting in this part of our company. Can we borrow against it? Can we scale that to support maybe a growth component of our company? And as we make markets out of everything, you will be able to have speculation across the board on different components. I do believe that this is actually blockchain's killer app, that it won't take the form of an application itself, but that it will allow us to create these dashboards, these bodily representations of a company, of its health, and with full real-time transparency of how it is operating. This is how investors want to treat their relationship with these entities. And of course, this unlocks a lot more capital movement across the various markets. So I think this is really exciting. And this is a narrative that I believe is the great unlock, and I will continue to build upon. Now, that being said, we have another day of, $500 million liquidated from the crypto market. You're only getting liquidated if you're putting on leverage. So as I always say, don't lever up, stay safe. Give me a like and a follow because I certainly appreciate it. It's what motivates me to keep on going. And I will see you tomorrow.